Hi everyone. Thank you for joining us. My name is Serena. I am a GP based in Southwest London, and I'm really excited about today's webinar. It's a topic that a lot of us have a lot of confusion about. We're going to give a few minutes, so the numbers are ramping up. So what I'd really like to do is there's a comment box on the right hand side of your screen. If you could kindly just say hello, tell me if you're a locum GP, a partner, and if you can hear me okay and see me okay. Sometimes with the internet speed, it looks like I'm lip syncing. I promise you I'm not. So hi, Aisha, Ahmed, Hussein, Chor, Lucy, Starla, a lovely name, Rupan, Kabanja, hi everyone. Can you hear me okay? Is the sound okay? And can you see the screen? That's the most important thing. The sound okay? Yeah.
Yeah.
Good. Okay. So, hi, Vogue. Thank you. Yeah, everyone can hear me. Everyone can see me. Hi, Sabri. Sabri's a locum. So, we're just going to give everyone like another minute or so to log on because everyone's the numbers are kind of going up every second. Where is everyone tuning in from? So, I'm in Southwest London. Thank you, Yusra. Yusra can hear us. Rabab can hear us. Nadia, hello. Rupert's like loud and clear. Hello, John. I recognise John from, I think, another one. Hi, Isma. Hi, Nadia. Birmingham. So Worcester, Corby. Oh, okay. Rod, I'm very jealous. You're on sabbatical in Brazil. Liverpool, I was there a couple of days ago. Northwest London. Hello. Huntingdon. Isma, you're in the USA. You're on holiday. Someone's saying I'm on mat leave. I know, but that's not a location. Dorset, mat leave in Dorset. Hello. Okay, great. So we're just going to give another kind of 30-40 seconds and see Middlesbrough. Hello. Sheffield, Essex. Hi, Aisha from Essex. Wow, Datchet. Oh, I know Datchet. Great. So lovely spread. Yes, welcome back, Mr. Deeks. Asim, you're in Japan. I'm very jealous. That's on my to-do list to go to. Oh, hi, Kabanja from Kent. Whereabouts in Kent are you? That's where my folks live. And we got Sheffield, Essex, Worcester. Great, good spread. So, shall we kick off? Shall we start? Great. East Lancs. Oh, hi, Elsie. I think we'll give it another like 10 seconds for everyone to be like, oh, I'm supposed to be on a webinar, and then we'll get started. Oh, Isma saying she travels back and forth. Okay, Gravesend. Oh, hello. Hi. Hi, Jennifer. Welcome. Hi, Anne. Great. Shall we start? So, as I said, I'm Serena. I'm a GP. I'm based in Southwest London, and I run a website for locum GPs called My Locum Manager. So if you're locuming, you should be on it. And if you're not on it, get on it. We run monthly webinars now, actually, and they're all designed to help you save money, work safer, work better, kind of really make the most of your kind of work life and your income. And I'm really delighted today to have this webinar because it's something that a lot of us have been very confused about, the NHS pension scheme. I know some of you will be limited companies that are tuning in, and others will be still pensioning their income. And I think I had quite a few emails through, actually, which I bombarded poor Nick with over the last few days, And I think a common theme about what kept coming through was, I don't really understand why I'm pensioning. I don't really understand what I'm going to get at the end of it. A bit about kind of what about new changes that have happened. And a lot of people saying, look, because of these new changes that have come in, is the NHS pension scheme really worth it? Because day to day, I'm kind of paying out a lot of money every month, going into Capita's black hole, and I don't know if I'm ever going to see it. So why are we doing this? And I thought, okay, let's kind of create a really financially empowering webinar, which we all kind of can make better decisions of as a result. So it's going to be really interactive. So make sure you grab a pen and paper and kind of take part in the exercises that we've inputted into it. So I'd like to introduce the lovely Nick Breyer. He's a financial planner for BHP, who are our main partners with these webinars, actually. We kind of really enjoy working with them. They really know their stuff, and they're really great at conveying that information on a level that we as GPs can all understand. So before I give the floor to Nick, I'd like to introduce the lovely Jenny, who is the healthcare partner at BHP, and she's going to tell you a little bit about BHP and what they do. Some of you might be looking for accountants, or you might want financial advice. So here's Jenny to tell you a bit about what they do.
Thanks, Serena. Hello, everybody. As Serena says, I just wanted to tell you a little bit about BHP for those who have not come across us before. So we're a top 40 firm in the UK. At the moment, we have 31 partners and over 300 staff and 5 offices in the UK. Within the firm, we have a large healthcare department, and that's headed by myself and also Colin Hoare. So Colin Hoare's with us tonight as well. So hello, Colin. So within the healthcare team, we have 30 staff at the moment who work full-time on our healthcare clients. We act for 95 GP practices and also over 400 locum GPs and hospital consultants. You'll no doubt have seen quite a lot in the news recently about large tax charges on doctors' pensions, and lots of doctors are reducing their hours, which is causing issues within the NHS. So myself and Colin are talking just about every day to doctors about tax charges on their pensions. So what makes BHP a little bit different from other specialist medical accountants is that we have our own team of in-house financial planners who have expert knowledge in the NHS pension, and that allows us to offer both tax and pension advice to our clients all under one roof, and our clients find that really useful. So without further ado, I'd like to introduce you to Nick Breyer, who is a chartered financial planner and also director of BHP Financial Planning. Over to you, Nick.
Yeah, thanks, Jenny. So evening, everyone. I think first of all, I just need to say with regards to the title of my presentation, I need to manage expectations here. Staying in the scheme or opting out isn't a straightforward decision. It'll depend on each member's personal and financial circumstances. So unless you're really confident about making important financial decisions, it's pretty sensible to take some professional advice. But hopefully the contents of the presentation will at least help you gain a better understanding of some of the issues that you need to consider.
Okay, this is, sorry, Nick, I just...
I'll go backwards.
Yeah, go backwards. So, as I said, for those of you that might be locuming or thinking of locuming, I run My Locum Manager, which is a really popular website for locum GPs. It does so much more than just take care of all your financial stuff, your invoices, planning and pensions and all the rest of it. We run these webinars monthly. We do lots of discounts off CPD and medical equipment and education courses, and the site's just super popular because it pretty much does everything in a very user-friendly way. So I was going to say, if you're already using it, a couple of things: make sure you take advantage of the refer a friend discount, because I often have to remind people, and but every time you refer somebody, you get 3 months off the software, which is really useful. And if you're a first 5 GP, there's an exclusive discount through the RCGP, so just email us and make sure you take advantage. if you want to use something like this that's really user friendly and switch over, we can help you do that. It's very effortless, and I'm sure, like all the people that use it, once you use it, you will love it. So let's. I couldn't play the video, Matt.
Not that.
No.
So this is, yeah.
I had this really cool little video I wanted to play you, but anyway, doesn't matter. Another time. Okay, so I'm going to hand over to Nick now, who's going to go through just a little bit of housekeeping. So I really want this to be as useful as possible for you guys. So put your questions in the Q&A box, and we'll do those right at the end. For those of you that have tuned into our webinars before, you'll know that a 1-hour webinar turns into like a 2-hour chat, because we always all get a bit carried away. But today we're going to try and be strict and kind of finish on time today. But we're running kind of loads more anyway, so you'll always get the chance to get more information. And Nick's going to leave his email address at the end, so you can follow up there. And do take part in the activities that we've got, because it's going to help you draw the most of all the things. And I think that's about it. My email address is on the end if you have any particular questions. Okay, over to you, Nick.
Yeah, thanks, Serena. So in terms of the agenda, I'm going to provide a basic overview of the NHS pension scheme, or schemes, seeing as there's more than there's one sort of section to the NHS pension scheme. Highlight some possible issues that members, particularly high-earning members, need to be aware of. Cover some changes in the scheme that are coming down the track, which are designed to make the scheme more flexible. For anyone who's already left the scheme or just are in the future, provide a brief overview of some other savings and investment options that you might want to consider. And as Serena mentioned at the end, myself, Colin, Jenny, stay on the line to answer any questions which crop up during the presentation, and also some of those questions which have been sent through in advance. However, before I start diving into any detail about the nuances of the NHS pension scheme, having worked as a financial planner for almost 30 years, I think it's important to start by thinking about what your retirement planning and financial planning is really all about at a high level. And in my experience, having asked hundreds of clients the same question, which is, what is your one major overriding financial objective? Although different people articulate their answer in different ways, for the vast majority, the answer can be summed up by what's on the screen now, which is working out what they need to do to be able to afford to live the life they want without the fear of running out of money at some point in the future. And what I think is a good point in starting to achieve this is to think about, where are you now? So look to say download, hopefully get some reasonably up-to-date information around where you are with your NHS pension benefits. Look at sort of downloading some state pension forecasts, and start to think about how you spend your money now and how that might change in the future. For most of us, when we retire, we'll no longer be making mortgage repayments, paying school fees, paying pension contributions and national insurance, and we'll almost certainly be paying less tax. So therefore, if you're happy with your current lifestyle, the amount you might need to maintain that lifestyle in retirement is quite possibly less than you think. You need to consider what other financial resources might be available. For example, perhaps you've got some other savings or investments, buy-to-let properties, or anticipate receiving an inheritance. And then you can then maybe start to work out what's important to you in the short term. Is it all about minimising tax, building up more retirement savings, reducing your working hours, preserving death in service and early ill health retirement benefits? And once you've answered some of these key points, you can then perhaps start to kind of build a bit of a plan or engage with a professional advisor to provide some help. So, in terms of sort of setting the context, I hope that sort of makes some sense.
And I would say, Nick, sorry to interrupt, I would say for everyone tuning in, like definitely kind of do go through this list, like now as you're doing the webinar, because I know a lot of us don't really think about all the outgoings we have. We just try and, work to earn and get as much in as we can, but we don't really think about where it's going and what our future needs are going to be and what we're actually trying to achieve. And I think that cannot result in burnout, but can result in a big tax bill as well. So it's definitely worth just thinking about these bullet points and then using this as a basis for what you're trying to get your pension to do or what you're trying to work to in the future.
Yeah. Thanks, Rena. So if we now move on to the NHS pension scheme, so let's start again with an overview of what the scheme provides. So in basic terms, a predetermined level of pension benefits which are secure, inflation-proofed, and provide the facility to take a portion of your benefits in the form of a lump sum which is tax-free. In addition, if you die either before or after retirement, the scheme provides both lump sum and pension benefits for those you leave behind. And finally, you'll also receive potentially valuable pension benefits if you're unfortunate, to need to be able to retire early on the grounds of ill health. So, in summary, the scheme provides very valuable benefits, meaning anyone considering opting out of the scheme needs to think very carefully about doing so, and should probably take some professional advice from a financial advisor who's got lots of experience in advising medical practitioners. There are 3 sections in the NHS pension scheme, and members will have membership rights in one or more of these sections. Although the contribution rates for each section are identical, each section has got different rules around how your pension builds up, when you can take your benefits, and how lump sum benefits are calculated. Until 2015, there were just 2 sections. The 1995 section, which applied to any members whose employment commenced before the 1st of April 2008, and the 2008 section, which applies to any members starting their employment after the 1st of April 2008. And the main difference between these 2 sections, the 1995 section has a standard retirement age of 60, whereas in the 2008 section it's 65. And also the 1995 section will automatically provide a lump sum at retirement of 3 times the pension, whereas the 2008 section allows you to build up a pension at a faster rate, but you then have to sacrifice part of that pension if you also want to benefit from a lump sum. In April 2015, we also saw a new scheme introduced, which, surprise, surprise, is referred to as a 2015 scheme. This scheme has got a standard retirement age, which is aligned to state pension age. So that could be anywhere between the age of 65 and 68. And there's also a slightly different way in which the benefits are built up. Whether you're impacted by the introduction of the 2015 scheme will largely depend on how old you are. Essentially, if you're already within around 3 years of your normal pension age, you'll stay in your current section. If you're more than 3 years away, you'll have either already moved into the 2015 section or will do so at a future date, and will then get benefits from both the 1995/2008 sections and the 2015 sections. And what's really important is that any benefits you've already built up in those 95 and 2008 sections will be fully protected. With regards to how your pension builds up and how much you need to pay in, due to time constraints, I can't provide examples across all 3 sections. However, if we just look at the 2015 section, which is, I guess, where the majority of the members will currently be accruing benefits. So if we take Dr. Smith as a GP locum with annual pensionable earnings of £80,000, so in terms of his employee contributions, his earnings sit in a band where he pays in at a rate of 13.5%. He also benefits from an employer contribution rate of 20.68%, of which about 14% is paid to him directly by the practice, which we then forward onto PCSE, with the remainder paid directly by the Treasury. However, as his employee pension contribution will attract income tax relief at his highest marginal rate, so in Dr. Smith's case that's 40%, in terms of his personal cash flow, the annual cost of being in the scheme is just under £6,500. In return for that contribution, he receives effectively a pot, which represents the annual pension payable at his state pension age. And the value of that pot is calculated as 1.85% of his pensionable earnings. So in this case, 1.85% of £80,000 is £1,480 per year. And then what happens with that sort of pot is that until he retires, the value of that pot is increased at a rate which is 1.5% more than inflation. And then each year, he effectively receives a new pot, and the value of all those pots, after they've been revalued, will form his annual pension. And once that pension starts to be paid out, the pension will increase each year in line with inflation. And also, when Dr. Smith retires, within certain limits, he can trade down pension income in favour of a lump sum. And this uses what's called a commutation factor, which in the case of the NHS pension scheme is 12. So essentially, if you gave up £5,000 per year of pension, in return, he'd receive a sort of a lump sum of £60,000. So I guess the important question is, does that actually kind of represent sort of good value? So to keep the whole thing really sort of simple, if we say that, let's say Dr. Smith joined the scheme at age 65 and was entitled to draw his benefits at age 60, he'll have been in the scheme for 1 year at a net cost after that 40% tax relief of just under £6,500. He then receives, in return for that contribution, an initial gross annual pension of £1,480 per year, and then going forward, that sort of pension will increase in line with inflation each year. If he predeceases his wife or civil partner, they'll receive half his pension for the rest of their life. And if we then sort of compare that cost of £6,480 against what it would currently cost in the open market for a 66-year-old to kind of go out and buy an index-linked pension of £1,480 per year with a 50% survivor's pension. I just had a look at sort of some annuity rates earlier today, and the current cost is around £60,000. And it's for those reasons that I feel that unless the cost of sort of contributions is sort of causing severe financial hardship, it's going to be in the best interest of the vast majority of members to remain in the scheme. So just a couple of slides now on helping you to understand again some of the mechanics behind how the NHS pension scheme operates and is managed. So with regards to the administration of the scheme, for practitioner members, the overarching employer is NHS England, who subcontract the collation and management of membership data to Primary Care Support England, PCSE, who then kind of contract actually that out to sort of Capita. So that membership data is then supplied by sort of PCSE stroke Capita into NHS pensions, who then use that data to sort of calculate your sort of benefits. And certainly in my experience, if you are struggling to obtain sort of meaningful up-to-date benefit information, the issue is generally to do with that blockage in the flow of information from PCSE to NHS sort of pensions, and sort of hopefully some of these issues I think you will be well aware of over the last sort of few years will soon start to be sort of ironed out. I'm conscious a lot of the audience will be sort of GP locums, so again specific to GP locums, there's a set process for how you sort of pension your earnings. Again, I wouldn't claim to be an expert when it comes to the administrative aspects of the NHS pension scheme. However, hopefully this slide it briefly explains the process, which is essentially all around sort of completing and submitting various forms and sending off sort of contributions within certain timeframes. And certainly using a service such as that provided by My Locum Manager will help you to save time and keep on top of all the business admin around invoicing, chasing payments, and completing the sort of pension forms.
I will say here, Nick, sorry to interrupt, because there have been a couple of questions just saying, kind of My Locum Manager, does it just do pensions? Is it like the other basic organising softwares out there? To be honest, it's been so popular because it does so more, and it's so nice to see like John Deek's comments and Bilal's comments and everyone else's comments about how useful they find it, because it's not just really simple to use and does all your sessions and you can like save it as a web app on your phone and take pictures of receipts and store your expenses and your mileage on there. You can also directly link to Capita's website on the Pension Form B page on there, but you also get access to these webinars, discounts and learning and financial learning. Now, obviously, some of these webinars we open out to everybody, no matter what you're using, whether you're using pen and paper or whatever, but most of the webinars going forward are just going to be for BHP and My Locum Manager members, and other people can subscribe on and pay for the members, but for our members it's always going to be a free access to this learning. And it's just because the webinars are so popular and we kind of obviously want to make sure we channel those and support those members. So but I hope that answers the questions for people having about kind of getting on to try it, and I'd say just try it and see how you go. We've had really positive feedback, and I guess as a locum GP myself, I kind of understand kind of the support I need, which is stuff that you guys need as well. Okay, so back to you, Nick.
Yeah, so thanks, Serena. So what I want to do is get a bit more technical and dive into some stuff which has been causing certainly many of our GP clients some concerns, especially as these issues can lead to some unwelcome additional tax charges. So starting with the lifetime allowance. So this is the overall limit that an individual can accumulate in pension savings without suffering some additional tax charges. The limit's currently 1,055,000. It was as high as 1.8 million back in 2011, 2012, but gradually dropped to as low as 1 million by 16, 17. However, in the last couple of years, some inflationary increases have been applied, and it's expected that that pattern will sort of continue into the future.
Nick, sorry, can you just explain what you mean by the lifetime allowance?
Yeah. Okay. So this is what the lifetime allowance is, and I'll come on to some examples in a sort of couple of slides. So it places a limit on the amount of pension savings that you're allowed to kind of build up without then sort of facing some additional sort of tax charges. And it's probably best illustrated if I go through in sort of 2 or 3 slides with an example. So, and then if you do go over that sort of lifetime allowance, that excess, then it's subject to a tax charge of 55% if the excess is taken as a lump sum, and 25% if it's taken as an income. And NHS pensions generally deal with excess lifetime allowance charges using the income method, and also come on to an example shortly. But also what's really important to understand is that with the lifetime allowance, it's only tested when you start to draw your benefits from a pension scheme. So it's not something you need to immediately worry about if you're already over the allowance but haven't yet retired. So in terms of how benefits are valued for the purpose of testing against that lifetime allowance, so with what are called money purchase pension funds, so the type of sort of pension scheme that I've got at BHP, where I pay a contribution into a fund, and the firm pays a contribution as well, and that fund's invested and hopefully grows over the sort of the years. So those are kind of called sort of money purchase pension funds, and with that type of pension scheme, it's really easy to look at how you value that fund against the lifetime allowance. And you just simply look at the value of the fund on the date that you sort of take benefits. However, with a defined benefit scheme, such as the NHS pension scheme, where there isn't an underlying fund, a capital value has got to be placed on the benefits, and that's done by using a sort of formula where you multiply the pension by a factor of 20, and then you add on the value of the sort of the lump sum. So, but the best thing to do is look at an example here. So if we've got Jim, who's retiring, is a member of the 1995 section of the NHS pension scheme, so gets a standard pension and then a standard lump sum of 3 times a pension. So if we take his pension of £48,000 a year, and then by default he'll get a sort of minimum sort of lump sum of 144,000. So again, if we apply the formula there, so we multiply the pension by 20 and then add on the value of the lump sum, it gets us to £1,104,000. So current lifetime allowance, as I mentioned earlier, was £1,055,000. So we've got an excess of £49,000. So how NHS pensions then sort of deal with that is that excess is subject to a tax charge of 25%. So 25% of 49,000 is 12,250. But rather than having to sort of kind of get his checkbook out and pay that tax, it's then collected through a lifetime reduction in his pension. And the factor used for converting that tax charge into the reduction in pension benefit is based on the member's age at the time the benefits are drawn. So for fairly obvious reasons, as your age increases, the factor decreases to reflect the fact that the tax needs to be taken over or recouped over a shorter time frame. However, generally a factor of about kind of 20 is applicable to sort of most of the members who are kind of around sort of normal retirement age. So in this case, the reduction in Jim's annual pension is £613, so meaning his pension reduces from £48,000 a year to £47,387 a year. There's no impact on the sort of the lump sum. So again, in this example here, I think hopefully most people would agree that that reduction in sort of pension isn't a kind of a life-changing amount, but clearly for members who've built up more substantial sort of benefits, those sort of tax charges sort of could become sort of more of an issue. However, if Jim wanted to do a bit of planning, so if he was hell-bent on avoiding that excess lifetime allowance tax charge, there will possibly be a way around this. So as I briefly mentioned earlier, the NHS pension scheme allows members within limits to convert pension income into a higher tax-free cash lump sum. So again, just to recap, so for every pound of pension income converted, the lump sum is increased by £12. So again, if we look back at sort of Jim's case, his pension benefits were £48,000 a year and a lump sum of £144,000, meaning a capital value of £1,104,000. However, if he decided to convert £7,000 of his pension income to increase the tax-free lump sum, so that would give him an extra lump sum of £84,000, his revised benefits shape then looks like a pension of £41,000 a year and a lump sum of £228,000. And then again, if you kind of work through the calculation, multiply the pension by 20, add on the value of the lump sum, that gives a capital value of £1,048,000. So just within the current lifetime allowance, meaning it doesn't sort of suffer that sort of £600-700 lifetime reduction in his pension. So if lifetime allowance wasn't sort of complicated enough, we're now probably moving into the most complicated sort of bit of the sort of the presentation, which is around the annual allowance. And the annual allowance, this is that places an upper limit on the amount that can be deemed to have been paid into a pension scheme without facing additional sort of tax charges. And again, in terms of a bit of history on this, the limit's previously been as high as £255,000. It was then sort of suffered a big cut to £50,000 in 2011 and was then further pared back to £40,000 in sort of 2014. And then again, to sort of further complicate matters, 3 years ago, there was also introduced as the possibility where the annual allowance of £40,000 can be reduced further. And also, again, I'll sort of come on to that by way of an example in a sort of few slides' time. If you go over the allowance, then any excess will be effectively sort of taxed at your sort of highest marginal rate. So if you've got a standard allowance of 40,000 and you've got no unused relief, then and you've got a pension input of £50,000 and that excess of £10,000, you're going to sort of pay potentially sort of 45% tax on that. But one quite useful sort of feature with the annual allowance is that if you've got any unused allowance from the previous 3 years, then you can sort of carry that unused allowance sort of forward. And again, if you do end up with an additional tax charge, rather than get your checkbook out, as long as you act within certain timeframes, you can get the NHS pension scheme to sort of pay the charge, which they'll then claw back through a reduction in your eventual sort of pension benefits. And that process is what's called sort of scheme pays. So again, it can be quite useful for some clients, where perhaps you haven't got the financial resources to sort of pay any sort of tax charge out of their own sort of pocket. But what it's important to understand with sort of scheme pays is that it operates as a loan arrangement. So effectively, NHS pensions will pay that tax charge on your behalf, but between that point in retirement, they'll then add interest at a rate which is about 2.5% over inflation to that sort of debt. So if we work on inflation of 2% a year, then with so you're looking at an interest rate of nearly 4.5% a year. So with compounding that sort of effective interest and interest, then the debt more than doubles after 16 years. So again, scheme pays, it's a useful feature, but it could be a bit painful for younger members. It will of course be more heavily impacted by that compounding of sort of interest on interest. So with the annual allowance, I suppose it's useful to understand what exactly is £40,000. So again, the type of sort of pension scheme that I'm in, a money purchase scheme, it's really easy. You just simply look at the amount that's physically being paid into the sort of the pension scheme within the sort of the tax year. However, for those defined benefit schemes like the NHS pension scheme, it's more complicated, and again, it's calculated by putting a capital value on the increase in your pension benefits over the sort of the year in question. And this method uses a factor of 16, so you multiply the increase in pension by 16, and then also add the value of any increase in lump sum entitlements. So in other words, your tax position is largely going to be based on the amount that you deem to have paid into the scheme, which bizarrely may or may not bear any resemblance to the amount of sort of pension contributions that you've actually paid into the NHS pension scheme. So if we look at an example here, so this is Dr. Smith, who's in the 2008 scheme and has earnings of £150,000. You'll see on the slide there I've put in brackets sort of fully protected. So what I mean by that, he's of an age where he's within, he's quite close to his scheme's normal retirement age. So he hasn't and won't transition into the sort of the 2015 scheme. And for GP practitioner members, then how their sort of pension benefits are calculated is with reference to a percentage of their overall career earnings, which are then revalued to take into account inflation. So in this case with Dr. Smith, he's got career revalued earnings of £2.7 million. So his accrued pension entitlement in the 2008 section is 1.87% of that amount. So he's built up a sort of a pension entitlement of £50,490 per year. So what we need to then do with the annual allowance is, as a sort of the first step, is working out where the value sort of sits at the start of the sort of the tax year. And we use an example here in the sort of the 17-18 tax year. And so we know that his pension entitlement was 50,490. We multiply that by a factor of 16, which gives us that number of 807,840. But then what you're then allowed to do with the annual allowance is that you're allowed to then uplift that number with reference to inflation. So in this case, I've assumed an inflation rate of 2%. So that opening value is bumped up from 807,800 to just under 824,000.
Sorry, Nick, could you just clarify one thing if you go back to that slide? So what is CPI?
Yeah, so CPI, I should have explained. So CPI stands for sort of Consumer Prices Index. So that's one of the sort of the government's sort of main inflationary sort of measures. So the other one, which has been around a bit longer, is RPI, which is sort of Retail sort of Prices Index, and it's all based on kind of working out the sort of the price of the kind of a basket of sort of goods. So it's a government kind of recognised measure of inflation. And typically with pensions these days, when it comes to what inflation measures used, then it's sort of CPI, which I think is generally regarded as being a more accurate sort of measure of inflation than RPI or Retail Prices Index.
So to make this really simple, because I think some people are getting a bit lost with what this actually means. So can you really simplify this part about essentially when you're saying annual allowance calculation? So here, Dr. Smith, what you're saying is he's worked kind of all through his career as a GP, and then when he comes to retirement, he has collated 150,000 in his pension pot.
Now, what we're saying is that Dr. Smith is that at the moment he's got earnings of £150,000 a year.
A year, okay.
Yeah.
And
then where that figure for career revalued earnings comes in, Serena, is that when you're a practitioner member of the scheme, is that how your sort of pension benefits are calculated, is that one of the sort of the functions of the NHS pension scheme is that they will sort of keep a record of all of your historic earnings as a GP.
Yeah.
And then what they will then do is that each year, all those sort of historic earnings will then be revalued using an inflationary sort of measure. So what we're saying that with Dr. Smith, if we look back at all his career earnings as a GP,
Yeah.
once they've been revalued to take into account inflation and added together, that lot comes to £2.7 million.
Okay. And then once you've got that 2.7 million.
And then once you've then got that figure, how it works, and it varies from sort of section to section, but in the 2008 scheme, then to work out the member's pension is that you multiply those career revalued earnings by a certain percentage from the 2008 section. So you can see there kind of point one of sort of step one is that the percentage that's used is 1.87%. So what we're essentially saying here is that for Dr. Smith, as at the 6th of April 2017, the value of the pension benefits that is kind of banked in the NHS pension scheme to be paid out and when he gets to age 65 is 50,490.
Okay, and what does the £823.99 997 mean?
Sorry, where's that?
No, point number 3 where you've got the total.
Yeah, okay, right. So if we go back to steps to
1,000. Yeah.
Point one of step one, we've worked out where his pension sits as of the 6th of April 2017, which is that figure of 50,490.
Yeah.
And then to put a capital value on that for the purpose of working out the annual allowance, then the Inland Revenue say we have to you have to kind of use a factor of sort of 16. So 16 times 50,490 is that figure of 807,840.
Yeah.
And then where the 823,997 comes in, it's the 807,840 that's then uplifted or increased by that inflation measure, CPI Consumer Price Index, which we've assumed in this case is 2%. So 807,840 plus 2% gets us to a figure of 823,997.
But what I'm saying is the 823,997, is that his annual, is that his total pension? What is that? What is that number?
Now that in fairness, then that number, apart from sort of calculating for the annual allowance, is pretty meaningless in practical terms. It's just a number that needs to be kind of worked out to kind of work out that, to put a capital value on how those sort of pension savings are built up.
Okay, so what you're saying.
Shall I go through the other sort of steps, Serena, and then hopefully that might kind of clarify things. And if it doesn't, then we can sort of go back.
Yeah.
So what we then need to do is then sort of work out where the value of his benefits sits in a year's time. So what's happened between 6th of April 2017 and 5th of April sort of 2018, which is called, the closing sort of value. So what we know is that what will happen to those career revalued earnings of 2.7 million, what will change over the year is that there'll be some more, indexation or inflation kind of applied to those historic earnings of 2.7 million. And also we're another year down the track. So he's earned another £150,000. So where he then ends up on the 5th of April 2018, if we're looking at sort of step one here, then we take those, updated career revalued earnings of 2,944,500, multiply that by 1.87%, and then we then know that his pension now, the value then sits at 55,062. We then multiply that by a factor of 16, which then gives us a closing value of 880,992. We then deduct from that figure the opening value from the previous slide of 823,997. So what's called his pension input amount. So the amount that Dr. Smith has sort of, has deemed to have paid into his pension scheme is that figure there of 56,995. So essentially what we're saying, if we go back to the sort of the previous slide, is that his pension did have a value of 50,490. It's now got a value of 55,062. And then when you kind of work the sort of the calculation out, is that increase into the pension value has got a capital value of 56,995. So if in Dr. Smith's case, working on a standard annual allowance of £40,000, he's actually exceeded that annual allowance by £16,995. So unless he got some unused allowances from the previous 3 years that he can then sort of mop up, then he'll end up with an income tax charge. So in his case, 45% of 16,995. So it's complicated.
Yeah.
But that's how it is.
I think what everybody kind of wants to know from this is, okay, so I've worked, up until my retirement, putting in, like, say, earning on average, I don't know, maybe let's just say 100k a year, and I've been pensioning, at a salary of 100k a year. Then I retire. Then kind of on average, how much money am I going to be getting every year? I know it's set to how much you've been putting in, but I'm saying for the average GP.
Yeah.
Kind of what?
So it depends on a whole host of factors and how old you are and what scheme you're in. I think as a general sort of guide, then let's say someone who's retiring this year, having been in the NHS pension scheme for 40 years, as a rough guide, could expect to receive a pension of around half of their sort of final kind of earnings and a lump sum of 3 times that amount. So so again, to put some numbers on that, if you're earning £100,000 a year and you've been in the scheme for sort of 40 years, then somebody trying this year, you could have an expectation of getting a pension of about £50,000 a year and then a lump sum of £150,000.
Okay, and then are you paying tax on top of that though, based on what you were saying?
Once that sort of pension scheme sort of comes, that pension benefit comes into payment. So someone with a pension of £50,000 a year, they then all of that sort of income would so what would happen there? The first £12,500 of income would be wouldn't be subject to tax, and then the next £37,500 of income would be subject to tax at 20%. So if I've got my maths right here, that's £7,500 in tax. So that's what they would then pay, once that sort of pension's in payment. I think where the complication is with this, and this is where it all gets, I'm afraid, horrifically complicated, for those kind of high earning members who are still in the sort of the scheme, where sort of potentially, because of the way in which it's calculated around the amount that's deemed to be paid into the sort of the scheme, then they can actually again sort of end up with some additional sort of tax charges. Okay.
That's a little bit clearer.
Yeah. It's if I could press a button that would make all this really simple, I would definitely press it.
Justine, I'm with you. Justine saying I'm lost. Don't worry, we're going to summarise it at the end. I think though, Nick, to be fair to GPs like myself and those that are tuning in, I think when we're trying to work out with the pension scheme, should we keep contributing to it? All these changes are happening. Oh, now I've been moved from one scheme to the other. Oh, now the retirement age has gone up. Oh, now annualisation has come in. When all these things happen, it is such a complicated system. It gets very difficult to actually make comprehensive decisions, because even looking at all this, I was just thinking, right, I'm totally lost, because I don't know what age I would retire. So if I retire early, that means I'm getting less than that, and I'm going to have to pay tax on. So I think everybody's kind of following those trains of thinking, okay, so hold on, if I'm contributing every year, it's going to be the assumption that I contribute right up until I retire. Obviously, many of us are women, so we're going to have maternity breaks. And I know a lot of mums that have tuned in, because you all messaged me to say some of you have been hit by annualisation and things like that. So I think I appreciate where you're coming from because it is hugely complicated, but I think it's a lot of that complication means we often don't know if we're making the right decision by contributing to it, or maybe looking at other options, or whether we carry on and just get to
I think what I would say there, Srini, is that for the vast majority of members who, where they sort of value having a, when they get to sort of retire, and we're all, of course, all sort of living longer these sort of days, is that I think you've got to place considerable value on having a secure, inflation-proofed income when we get to retirement. I think for the vast majority of sort of members, the most cost-effective way for them to achieve that is by remaining a sort of a member of the NHS pension scheme, where generally you will get tax relief on your the contributions that you're paying in, and you also then sort of benefit from the employer's contribution. I think that members who kind of tend to kind of opt out, in our experience, are typically those sort of clients where they're perhaps quite near to retirement. They've already sort of built up substantial pension benefits that are going to again tick that box around giving them enough income to be able to afford to live the to sort of live the life they want. And sometimes when they opt out, it's actually maybe more of a sort of a lifestyle type of decision, where they just want they think, actually, I've built enough pension that's going to give me the income that I need. But what actually I want to do, I want to reduce the number of sessions that I'm working, and to kind of make that affordable, then opting out of the sort of the NHS pension scheme, so they might make that sort of lifestyle sort of choice more affordable.
Yeah. Okay. No, I think, and I think that's a valid point about. I think one of the things we're lucky about with the pension scheme is, obviously, compared to, say, if we weren't in the NHS and we were contributing to the pension, I think the rewards aren't as generous as they are with the NHS pension scheme. And the other thing is, it does force you to put away money every month, because I think if you weren't having to put out those contributions separately, you'd probably have to look at being really, kind of really militant about saving regularly every month, or putting it in an ISA, or trying to do something else with that money to make sure you have something for when you retire and aren't able to work or don't want to work. So I think, there are definitely things. I think I do echo a lot of people's feelings about the complexity of it, though, means that sometimes it feels like we're not making an informed decision. We're just kind of going with this very scheme, not really knowing one way or another whether actually we would have been better off leaving, investing in something else, and then retiring, or whether we should have stuck with it. And I think that's kind of the point that many of us feel when we're kind of doing the day to day.
Yeah, and I think perhaps a good sort of barometer of this is that for anyone who's perhaps sort of not understood the last sort of few slides, and I suspect that's probably quite a lot of people, then you probably shouldn't opt out of the scheme unless you sort of take some professional advice. I mean, that's not mandatory. Anyone can opt out of the NHS pension scheme whenever they want. But my kind of guidance would be that unless you kind of understand the last few slides, and you're kind of really good at sort of understanding sort of numbers and sort of tax, then it's probably not the right thing to kind of make your own decision about sort of opting out. You probably need to kind of speak to a sort of a qualified financial planner who's got some experience of dealing with the NHS pension scheme. Because if you opt out, there's all kinds of potential sort of around impact on things like death in service benefits. What happens if you have to retire early on the sort of the grounds of ill health? If you're not in the scheme, then an active member of the scheme, then those benefits are less generous.
Yeah, okay, yeah, no problem. And Asim, yes, I do contribute to the NHS pension, which is why I'm very interested in this webinar, to see what I'm going to get when I finally retire. Okay, sorry, Nick, take it away.
Yeah, and again, I think when we spoke yesterday, is that one of the difficulties with these presentations is around trying to sort of picture at the right level.
Yeah,
I mean,
definitely.
We've got sort of clients on a regular basis who actually want to sort of try and understand about annual allowance and sort of tapered sort of annual allowance. So you've always got this sort of risk is that, lots of people think it's sort of too complicated, and then other people will think, actually, I'm a bit disappointed. It was a bit basic. I really wanted to learn something about annual allowance and tapered annual allowance.
Yeah. I think what's good is you've shared your email address at the end, so everyone can actually book on to speak to you and get your advice. And I think what you've hit home on is, if you're contributing to the NHS pension scheme and you're thinking of leaving, you really need to know what you're going to be losing as a result of it and understand the implications of that at the age of, for your future before you make that decision. So it's not something to really be taken lightly. So I think actually that's been a big learning point for me from that perspective. Okay, sorry, yes, carry on.
Yeah, so shall I just what I suggest then, Serena, is that if the sort of the annual allowance is a bit sort of tricky, then
God help the next
move on quite quickly through the sort of the tapered annual allowance. But what I'm happy to do is if there's anyone who's sort of tuned into the sort of the webinar that was hoping to kind of get something out about learn something about the sort of the tapered annual.
Yeah, put your questions.
Then feel free to get in touch.
Yes, definitely. That's a good idea, because we're going to run into the Q&A very soon now anyway. So
yeah. So if I then kind of just move on to this slide, which then talks about some sort of changes that are coming down the sort of the track with the NHS pension scheme. And I think it's sort of fair to say that with all the sort of the changes in pension rules and allowances over the last few years, is that more and more medical professionals have become impacted by these issues around annual allowance, tapered annual allowance, and lifetime allowance. And as a consequence of that, the government's been looking at ways in which some of these issues can be addressed. And back in July, they sort of published a 50-page consultation sort of document. But to kind of sum up what was said in that sort of document in a sort of a few bullet points, the main initial findings is that around that due to the impact of possible excess lifetime allowance, annual allowance tax charges, is that lots of sort of higher earning clinicians are looking at reducing workloads, turning down extra work and responsibilities, and retiring earlier. Also, again, to restrict the amount that's deemed to be going to a pension. You've got quite a few members, and we've seen it with a few of our clients who are adopting what's sort of called a sort of hokey-cokey approach to their NHS pension scheme membership, where they kind of opt in for a year and then opt out and then opt back in, and to hopefully try and swerve excess annual allowance tax charges. And it's generally kind of recognised that perhaps a sort of more structured approach might be more attractive to those sorts of members. Also, I'm afraid to say that the consultation did say that changes to the current pension tax system are considered unlikely. So I'm afraid, at least for the foreseeable future, it looks like lifetime allowance, annual allowance, tapered annual allowance are here to stay. And the main proposal put forward is to sort of offer what's sort of generically sort of termed as sort of a 50-50 option. And how that sort of works is that the contribution levels that you sort of pay into the NHS pension scheme will be halved, but also the rate at which you build up pension benefits will also be halved. So again, that will also help people who are perhaps might be kind of worried about, in particular, excess annual allowance sort of tax charge to allow them to stay in the scheme. But because of the amount that's deemed to be going in will drop down, it perhaps reduces the risk of those excess annual allowance tax charges. And again, importantly, with that 50-50 scheme, it will only affect the accrual of how the pension builds up. So any sort of death in service benefits, early ill health retirement benefits will still be covered in sort of full. Although again, even with this sort of 50-50 option, then the consultation did sort of recognise that even with that for some members, then it possibly won't eliminate excess annual allowance tax charges altogether. And then in terms of sort of the next steps on the consultation is that hopefully some more sort of concrete proposals will be sort of published later this year and sort of into the early part of 2020. And then sort of finally, I'm sure everyone's will be pleased to know the sort of the last of a couple of sort of slides. I just wanted to talk about, for anyone who's either already made that decision to kind of opt out, or anyone who's in a position where they've got a bit of surplus sort of income or capital, is just talk about very briefly about some other savings and investment options. And again, just need to kind of reiterate, I'm not suggesting that any of these sort of options are more attractive than staying in the sort of the NHS pension scheme. So certainly, for anyone who's just looking to got some surplus income or sort of capital, they just want to keep safe and have easy access. Then you could just look at some really simple savings products like kind of cash ISAs, which is essentially a savings account where you can put up to £20,000 a year in, and where the interest sort of builds up on a sort of a tax-free basis. Premium bonds is sort of something through sort of national savings, where again you can put up to £50,000 into sort of premium bonds, and any sort of prizes from that are sort of tax-free, and they use a notional rate of interest to calculate that sort of prize fund. So generally sort of premium bonds, you can expect to maybe sort of have winnings of about kind of 1.3 to 1.4% a year, and obviously you then got your kind of very traditional sort of bank stroke building society savings accounts. So those types of savings vehicles are ideal for investors wanting to keep it things safe and secure, easy to access, and in terms of returns, you're probably looking, if you do lots of shopping around, returns of about 1.5% a year. If, on the other hand, you're willing to sort of take a longer term approach, and perhaps sort of take a bit of risk, you might want to consider stocks and shares ISAs or collective investment funds. So these are investments where some or all of your money will be invested in the sort of the stock market. So potentially provide higher rates of return, but again, that it's important to research your options or take some professional advice there, so that you end up with an investment approach that's going to give you a kind of a risk and return journey, or investment sort of profile that you're going to be sort of comfortable, sort of feel comfortable with. Moving over the sort of page, again, property, always quite popular for sort of UK investors. So again, fairly obviously with sort of property, if you're investing sort of property, there are two ways in which you can get a return. Hopefully, growing the underlying sort of value of the property, and then also through receipt of rental income. Again, I think a key thing with property, take into account the costs of buying property, selling property, and its ongoing sort of maintenance. And again, if you want to, there's lots of, if you wanted to kind of look at a mortgage there to buy a higher value sort of property, then there's lots of buy-to-let mortgages available in the marketplace. And then sort of finally, the last sort of point there, high risk investment, which is sort of tax advantages. So again, these are more specialist investment schemes, perhaps suitable for more experienced investors. So venture capital trusts. So that's where you can invest in potentially high growth sort of companies, but you get a 30% income tax relief on that. So effectively it costs you 70p to invest £1, but you need to kind of hold on to that VCT for 5 years. And again, with the investment returns there, with the venture capital trust, any growth in the value of the investments or any dividends that are provided are paid out tax free. And then finally, kind of enterprise investment schemes, which, in my opinion, can sit right at the very top of the investment risk sort of spectrum, where again you get 30% income tax relief, but you've got to hold that investment for 3 years. And again, with enterprise investment schemes, a couple of additional tax advantages is that if you've held that enterprise investment scheme for more than 2 years and you're holding it at the time of death, then the value of that investment will be outside of your estate for inheritance tax purposes. And then also with enterprise investment schemes, you can use it to defer a capital gain. So if you've sold an asset, perhaps it could be a buy-to-let property, it could be some type of sale and lease back arrangement on some surgery to the premises, and you've got a gain there that you're going to pay tax on, then by reinvesting the proceeds into an enterprise investment scheme, then you can sort of defer having to pay that sort of capital gains tax bill. But again, with those last two there, so venture capital trust, enterprise investment schemes, the type of things that really are only suitable for experienced investors willing to take sort of high risk, and most people will probably want to get some advice about the suitability of those types of investment. And that's really kind of wraps things up in terms of the presentation. So
great, thank you. So should we crack on with the questions? We've had quite a lot through, so I'm going to try and consolidate them and cover as many as possible. So I think some of the questions were related around, I think, like GPs wanting to do a bit of both. So some had set up as a limited company, but were still doing some work as kind of self-employed GP and paying into their pension pot. And I think a lot of them were asking, first of all, is that okay to do? And second of all, are there any tax implications of doing that?
If I can pick up the sort of the pension issue around if you're kind of routing any sort of any locum income through a limited company, then you can't use any of that income to sort of pay the pension contributions on. I don't know if
no. So they're working. So they're kind of doing a bit of both essentially. So they're working through a limited company, and I think probably thinking about a private pension scheme or something like that. And they're also doing some work in the self-employed capacity, and sorry, not self-employed, as a kind of sole trader, and then pensioning some of that, some of the the sole trader income. So they're doing they're basically keeping a little bit ticking over into their pension pot. But I guess from what you've shared already, it means if you're putting in less, then you're probably going to get less out at the end. Yeah. But do you still
the private pension investment against limited company income? They're entitled to do that, but they really need to consider whether they're getting the best return that way, whether they've got the availability of the NHS pension scheme. And every situation will be different.
Yeah. And I think also, Serena, with anyone who's considering kind of making some significant changes to how they sort of structure their sort of income and sort of pension affairs, I think it's just worth hanging fire on that and just actually kind of waiting to sort of see what comes out of the sort of the consultation. So that certainly lots of the kind of clients we've been sort of talking to who face these issues is that I think this if it ends up being a sort of a 50-50 type of arrangement, I think will be quite attractive to quite a few of them.
I think the consultation's actually gone slightly further in the last few days, where the government are now suggesting there may be an option of picking the percentage you want to pension your income. So it could be anything between 1 and 100% effectively. They've moved on slightly very recently, but the outcome won't be known until next April. The consultation finishes 1st of November.
Yeah. And Andrew's asking, so he's saying, from my perspective, I'm in my mid-30s. As such, nearly all of my contributions will be in the 2015 scheme. I suppose the question facing people in my position now is, if we had a relatively consistent income, what threshold of earnings now would we need to worry about to avoid taxation on our pension in the future?
So in terms of the sort of the annual allowance, then really anyone who's got kind of earnings of over £100,000 might it's something that they need to kind of perhaps get a grip on how it actually sort of works. But anyone in our experience, anyone sort of earning say less than sort of six figures, then I think it's unlikely that they'll face any issues around the annual allowance. So that means that they can then sort of rely on getting full income tax relief on the value of their pension contributions.
Okay, so essentially, don't earn over six figures, Andrew. You should be okay. So Hayley and Asim are asking quite an important question, which has come up a few times. Do we think the NHS pension scheme will still exist in 30 years when a lot of us are supposed to retire? And what happens to the money that I've already paid in if the scheme collapses?
Okay. Well, I think because the NHS pension is kind of backed by the sort of the government. Then I think that the country would have to be in an absolutely kind of sort of terrible sort of state, where it hasn't got the sort of the wherewithal to kind of pay out sort of pensions to all those retired previous sort of NHS employees, and then also what we've actually kind of seen in sort of in over the last sort of 10, 15, sort of 20 years, is a move towards sort of making pensions more affordable. So again, we've seen the 1995 scheme, retirement age of 60. So the 2015 scheme, that's sort of pushed out to age 67. Also at state pension age, which could be between 65 and 68. So I think with that, we're all working longer. But hey, thanks to all the great work you guys are doing, then we're all living longer as well, aren't we?
Yeah, no, that's true. Okay. Starla's asking how do we find out how much money we have in our pension to date?
Okay, so the easiest way to do that is to if you log on to the NHS pension scheme sort of total rewards portal. So if anyone wants to email, I can send a link through. If you just Google total rewards, then there's an NHS pension sort of website there where I think you can actually register for that immediately, and you can then sort of download a sort of a benefit sort of statement sort of showing the latest value of your benefits. I say latest value is that we find that with a lot of those, the information's maybe 2 or 3 years out of date, and again, that's all to do with something I sort of covered on one of the earlier slides around a blockage in that flow of information from PCSE to NHS pensions.
Okay, another common question has been from people saying, essentially, what if they follow your advice and they're contributing to their pension, but then they change careers, or they leave general practice, or they move abroad. What happens to that money that they've invested so far, and what does that mean for them kind of going forward?
Yeah, so what would happen there is if you've been in the NHS pension scheme and then there's a change of circumstance for whatever reason and you sort of leave the scheme, then you become what's called a deferred member. So what then happens is that on the sort of the date that you've left service, then they can sort of effectively draw a line in the sand and say, well, look, as at this date, this is what your pension entitlement was, and then between that point up until you retire, then the value of those benefits are increased each year in line with inflation. So in other words, very simple terms, what you've built up will be banked and safeguarded, and will then continue to increase in line with inflation.
Okay, and I think one thing we've all got to remember is it's not just the pension from our, since we qualified as GPs, this will be money we've paid in as F1s, F2s and SHOs and stuff like that. So it does span kind of quite a significant part of our career. So I guess even if you leave, that's still something to look forward to if you live up to the age of retirement, or otherwise I guess your spouse will benefit. So Rupen's asking an interesting question. I think this probably touches on something you've already mentioned. So Rupen was a GP partner for 10 years and paid into the pension scheme, and also the hospital NHS pension before that as a hospital trainee. Now is doing a minimum amount, about 1 session a month, but is ticking over small amounts of payments to the pension scheme, and was saying, is that a sensible plan?
I don't think it's an unsensible sort of plan. So just run me through that again, Serena. So he's worked as a.
The question really is, Rupen was working as a partner, so has contributed significant amounts to the pension scheme as a partner, and before that when working in hospital, but now is actually only doing about 1 session a month. So is actually contributing only a very small fraction of what he was contributing before. And I think he's essentially asking, is that sensible just to keep a very small amount trickling in, even though you're not doing quite large payments?
Yeah, because he'll continue to kind of sort of build sort of benefits up, and again, because of how practitioner sort of pensions sort of calculated, then even though his earnings have significantly reduced, then that won't have any sort of negative impact on the sort of the fact that when he's previously sort of contributed, he's had a much higher level of earnings. So I think as long as the contributions are affordable, then I would suggest it makes sense to remain in the scheme.
And Ada's asking a really important question. Locums aren't entitled to death in service benefits at the moment. So what are the benefits in terms of their pension that they would be entitled to, and what will happen to the contributions of a locum in case of sudden death?
So I think that there's been some recent sort of cases where again, to me, it seems like something that will hopefully be resolved in the sort of the future. Where I think in terms of the death in service benefits, I think you have to actually die whilst you're sort of contracted to work, and I think it's recognised that that's a weakness that needs to be sort of looked at. But yeah, there is a sort of a risk there. I mean, certainly if you actually were to die at a point where you're not sort of working, then there would still be some death benefits paid from the scheme, but those benefits will be kind of less generous than you if you actually sort of died in service. And I guess a possible solution if you could say someone who's doing kind of locum where they're only doing a kind of a relatively small number of sort of sessions, and they did want to have that guarantee that there'll be a payment to their loved ones in the event of death, they could look to sort of take out some separate life insurance cover.
Okay, so I guess that's getting professional advice about getting proper insurance cover for if that happened, and there'd be a separate cost to that, I guess. Okay, so I'm going to wrap up now because we've done it. We've overrun again. What I'd say, there's been a lot of questions about annualisation, and we've done a really good webinar on annualisations with BHP, which was 2 months ago. So if you're already using My Locum Manager, you would have been sent a link for that, but I'll make sure I send it to you guys in the coming week or so you can rewatch that. For those of you, some of you got really specific questions about kind of high income and nest pension contributions and things. Nick's got his email there. Do ping it to him and just kind of run by kind of your more specific things in order to get cover. Asim and John, you've been hilarious as usual. I kind of want to invite you on for your own webinar, really. But thank you for being fabulous as usual. And yes, I can do webinars on income protection and investments and things. So I'll get together with Colin and Jenny and we can put something together. I know it was quite a lot in terms of all the numbers and things that were flying around, but I think I've made a few very quick summary points about the pension scheme, which I contribute to currently as a locum. I guess the things to think about, and Nick, you can jump in, if you think I'm saying something wrong or you want to add to it. But I think number one, you need to think about your career plan. So if you're going to be locuming up until retirement age or working as a GP up until retirement age, you do need some kind of plan for your income to then be able to see you through your retirement. And currently, the NHS scheme is one pot, but you could obviously diversify and go add to it with property, bonds, and I'm just going to go through that slide that you put here. So you could do the pension scheme, but it's also worth thinking about these additional options to top up so that you're not bound to it, but you're also maximising the return you get on your money. So it's not just tied into one pot, but you could kind of diversify your investment portfolio that way. Essentially, I think, Nick, from the numbers you were saying, to really simplify it, for those of us that are going to be working up until about 55, on average, the average GP could expect about £49,000 to £50,000 a year when we retire, plus a, what did you call it, Nick? The payment,
a
lump sum payment of, was it 150k?
Yeah, I mean, generally, it's three times the sort of the pension is what's paid out for the 95 scheme, with with the other sort of two schemes, so 2008 and 2015 scheme, then if you want a lump sum, you have to kind of trade down your sort of pension income to get that.
So that made me think, well, say I invested in a small property and it went up by 150k, by the time I retired, would I be happy with that option? I thought, yeah, I would be. So from that point of view, using that analogy, maybe having that, in your pension pot to look forward to is a good option. I think for locums in particular, though, things like death in service and making sure you've got adequate cover for that is important, because this is obviously on the basis and the assumption that we're all going to get to that age and get access to that money. So I think that's why those other things you've put up is definitely worth considering, especially for, ease of access, and maybe you want to buy a bigger house, or maybe you want to put your children in private school, all those kinds of things worth thinking about there. The other thing, which we touched on in the annualisation webinar, but very quickly for those mums out there that have taken breaks in the pension scheme. So I guess, Nick, what you're saying is, even if you're hit by annualisation, you're paying in more compared to, say, your salaried colleagues, you're saying still actually it's worth it from the perspective that you're getting the lump sum and you're getting tax relief on those pension contributions. And
I think if you go back to one of those sort of slides about that example for the member in the sort of the 2015 scheme, what we'd worked out is that at a cost of about £6,500, then he was actually getting something that's got a value of about £60,000.
Yeah.
Right.
Capital gain.
Most people should look to stay in the scheme.
Yeah, no, you're right. And I think Justine's put on a point across about the capital gains, about you would pay on property as well. So I think any way you're looking at it, you're going to be hit one way or another by tax or some kind of penal annualisation or something.
Yeah.
Just a question of sitting down with somebody that knows the numbers to say.
Yeah, I think have a plan and don't leave it to chance.
Yeah, no, I think that sounds really good. Great. Thank you so much, everybody, for tuning in. Our next one is next month on appraisal and things like that. And then we'll look to do one on expenses and the other things I mentioned, the investment and stuff. I'll lock down Jenny and Colin and get some dates in the diary for you guys. But thank you for joining me. Have a lovely evening. If you're a locum, sign up to My Locum Manager. Thank you, Asim. I'll give you your £10 later. But yeah, check it out. If you enjoy these webinars, you'll get access to all these and much more, and all the benefits of the system as well. So I wish you all a lovely good evening and a good weekend. And thank you for tuning in.
Yeah, thanks, Rita. Yeah. Bye everyone. Bye.